The BJP government has been elected on the promise of development and creating more jobs. So in my belief, while we have seen a lot of activity and action over the last few months, but this is also the first, so to say, formal process where there were enough time to review the status of the economy and present their entire thought process. So I think like all investors, almost all of us in the business community and the larger population is looking forward to understanding the plans of the government, and there are obviously high expectations. So let's take a step back and look at the demand supply for healthcare financing in the country. So the facts are, as a country, we spend upwards of 300,000 crore rupees a year, 3 lakh crore rupees a year on healthcare, which means when we fall ill, when we visit a doctor, when we need to get tests done in a diagnostic center, when we need to buy medicines, or when we are hospitalized. Already, as a country, we are spending 300,000 crore rupees. How is this 300,000 crore rupees funded today? The fact is that upwards of 70% of this 300,000 crore rupees is funded out of pocket. Health insurance is today a 20,000 crore business, and the central government and the state governments, through all their healthcare schemes that they run, provide anywhere between 40 and 50,000 crores. So upwards of 2 lakh crore rupees is being already spent by individuals like you and me when we fall ill and when we need to visit a hospital or a doctor. So logically, as this category evolves, in a lot of developed markets today, health insurance finances upwards of 85 or 90% of all healthcare spend. So there is a potential for this 20,000 crore business to go up to a 200,000, 250,000 crores, even if healthcare expenses remained stagnant. And the fact is that healthcare inflation in India is upwards of 12%. So in the foreseeable future, we believe this business is likely to continue to grow over the next couple of decades. So let's again, we are all aware of the general inflation in the Indian economy. Alongside, hard data proves that the health inflation in India is upwards of 12% a year. And what is fueling this inflation, what is causing this inflation? Around us, we all know that salaries are going up. We all know that land prices are going up, fuel prices are going up, so on and so forth. So obviously cost is going up. The additional piece that impacts health inflation in our view is the fact that there is new medical technology. And as new medical technology comes on, which is safer for the consumer, which has better clinical outcomes, at times cost also goes up. So in a scenario where there is healthcare inflation upwards of 12%, in a scenario where there is under-penetration of health insurance, there is absolute need to incentivize for consumers not only to buy health insurance, but also to buy adequate health insurance. So from that standpoint, the fact that the current limit is there is a section 80D under the Income Tax Act, where up to, if I buy for myself and my immediate family, up to 15,000 rupees is what I can get as a tax exemption, that amount I spend on health insurance premium. And if I were to pay for my parents, dependent parents, another 20,000 rupees is what I could get. Our view is that these limits have to inch closer towards 50,000 rupees. Given healthcare inflation and given the need to buy better health insurance covers. So that's, from an industry standpoint, that's the recommendation that we have made and we'll continue to make with the government. For that, we'll have to wait and watch, but we are hopeful that this limit of 15,000 has is not been corrected for the last 3 or 4 years, and in that sense, there is an urgent need now for government to once again create the right incentive. for more and more individuals to buy adequate health insurance. So once again, let's take a step back and look at what is the dynamic of the insurance business. This is a business which is, whether you cut across life insurance, general insurance or health insurance, it's highly underpenetrated. Second, this is a business that comes with long gestation periods. So for any new company that is set up, it consumes anywhere from upwards of 500 to crores of capital, and requires anywhere between 6 and 10 years for an entity to break even and become self-sustaining. Further, the Indian market is unique in the sense, because of the current stage of evolution, there is very little data available on mortality, morbidity, risk and so on. And to compound it, given the complexity of the Indian market in terms of the number of segments, sub-segments of consumers. So if I once again take a look at health insurance, all the products in the Indian market today cover for inpatient hospitalization. Almost no company today is able to offer health insurance covers for doctor consultations, for diagnostics and so on and so forth. And a lot of it is because of lack of experience, lack of data around offering these benefits to the consumer. So our view is the insurance ordinance and an FDI limit of 49% does two things. One, it provides much needed capital. Second, it creates an environment for international players with the necessary expertise to now come into India and be able to start deploying products where they have experience in international markets and customizing them in the Indian context. So from that standpoint, we get more knowledge and we get more capital, which is both of which are critical for increasing the penetration of insurance in the country. So we think it's a forward-looking step. It is the right step, and we are very hopeful that from here on we should start to see many more companies come in, and adequate protection is made available to the larger population in the country.